Nothing. Nothing but. Nothing but net. Net.
Welcome to Nothing But Net, the podcast for triple net commercial real estate investing. Before we get into the meat of today's show, let's recap on why there's so much interest and buzz around net properties. Triple net properties are commercial real estate investments where the tenants, usually brand name corporations, pay you rent every month. Can you say mailbox money? In addition, they pay the real estate taxes, insurance, and maintenance for the property. No toilets, termites, or taxes. What's not to like? You can remember what net or triple net stands for by using TIM, taxes, insurance, and maintenance. With triple net properties, there's lower risk income and cash flow because rents are guaranteed by strong credit tenants. Preservation of wealth, because rent increases and property appreciation are bulwarks against inflation and a great store of value. Tax efficiency. The government wants investment in commercial real estate, so they provide inducements through depreciation and deductions which shelter income from taxation. Tax deferral, which gives potential for infinite tax deferral with 1031 exchanges, which are very popular in the triple net space. Triple net properties are a tangible asset, and as Mark Twain once said, buy land. They ain't making any more of it. Hello and welcome back to the Nothing But Net podcast, the podcast for triple net commercial real estate investing. I'm your host, Adam Carswell, joined by our co-host, Michael Flight. Really looking forward to today's conversation. As always, we always have a bunch of fun here. Michael, we have a special guest with us today, Randy Blankstein. And before I get into Randy's background, I just want to flip it over to you and kind of tell us what you're looking forward to in today's conversation.
Well, I am looking forward to this because Randy Blankstein is one of the pioneer boutique net lease firms. And he's going to correct me, but I know he started this firm like in the mid 1990s when there wasn't really somebody that specialized in net lease properties. So Randy, I believe, is one of the most knowledgeable guys. I've seen Randy talk at a number of net lease. He's like a fixture on the talking circuit for the net lease circuit. So I think this is a really big get for us because I think a lot of people are going to get a lot of value out of somebody that's an industry veteran. And not only that, but I believe he started on the actual user side and figured out, what net leases were. And he figured out that, well, if I'm putting this stuff together, then I might as well actually just go out and broker it. So with that, I'm sure Randy's going to fill in some of that, but you give us the rest of the bio.
Sure. Just want to highlight again, Michael always does a great job finding the veterans for us. If it was me, sometimes I feel like I wouldn't know where to start. But again, we got someone here with here in his bio, over 30 years of experience. So here we go. Randy Blankstein is a commercial real estate executive with over 30 years of experience focused on advisory services in the single tenant net lease sector. He has led Boulder Group to a top 10 company national ranking for single tenant retail transactions by both CoStar and Red Capital Analytics from 2010 to 2020. Randy has founded and managed net lease companies on both advisory and principal sides that have been involved in over $6 billion in single tenant transactions. He's currently the chair of the Net Lease Summit Conference and has previously been the chair of the IREI Triple Net Investor Strategies Conference and the ICSC N3 Triple Net Lease Conference. That's just scratching the surface, ladies and gentlemen. Really honored to have Randy Blankstein here with us to share a little bit about his story and then also some very focused details that I know Michael's just ready to ask those questions. So Randy, if you don't mind, could you kind of just share, briefly a little bit about your story as well with our audience and then fill in any of the blanks?
You can correct anything that I got wrong or add to it.
First of all, thank you for having me at Nothing But Net. Happy to be here today. And I appreciate the introduction, even though, I think you've aged me a great deal by calling me a veteran and pointing out how long I've been in the industry. But I'll take it because it is what it is. Yeah, look, when I started in the kind of early 90s, graduated college, got into commercial real estate, represented AT&T. I was in charge of their industrial portfolio, which is the garage where vehicles go that serve, power lines and cable and other things go at the end of the day. In order to buy these properties from these individual owners who are in their 70s and 80s, they'd say, love to sell to you, but I have this low basis and can't sell because it's too big of a tax hit. I said, well, let me tell you what a 1031 exchange is, where you can sell the property and buy another without a tax hit. And I can get you into a long-term investment grade tenant, like a Walgreens, a Home Depot, et cetera. So did that for a few years, saw that was a huge business unto itself.
Can I interrupt you right there, Randy? Yep. I apologize, but how did you even know what a 1031 is?
It was pointed out to me because when I had to tell the people who had a low basis in their AT&T property, they said, look, it's too big of a tax hit. So I had to call some accountant friends of mine and explain to them and say, look, here's the tax problem that these investors are in. Is there anything we can do to help them out? And so it was kind of pointed out to me, and that existed. And B, also was pointed out to me that there was an industry of properties that they could trade into. I didn't originally know about, because I wasn't in investment sales, about Walgreens, Home Depot, and the whole net lease industry. And again, it wasn't a net lease industry at the time. There was just single tenant properties, and here were a few of the tenants. There wasn't net lease conferences. There wasn't a net lease REIT. It was just some of these properties existed, and some of the tenants' names who are barely around today, like Kmart, were kind of the big tenants at the time.
But I just want to point out, it's incredible that you founded this business basically by figuring out how to solve somebody's problem, which is what most successful businesses are. But, that's just a big tip for starters.
Yeah, look, it's obviously hard to figure out in advance. I didn't know these people, not much less their problems or how I could solve them when I first started, is trying to just make do as you go along. And the deeper I got into it, the better I kind of thought it was, which is, look, these are great for, older multifamily and other owners who are, looking for less active management, less risk, and, are seeking fixed income vehicles. And I think this is a better risk adjusted return than fixed income, which I know is something you guys agree with, but I think it's actually true. And I've seen this, myself, my, father-in-law happens to be an industrial developer who's going through the same later stage in life, looking for less risk and fixed income. And, this is a perfect vehicle for him. And I think thousands of others like him. So, it really helps when your industry is also something that you firmly believe in. And I think that day by day, even though there's public REITs, and even though net lease business is a lot bigger than when I started, I still think, it has a lot to go, and that until everyone knows about net lease and everyone is active in the industry, I still think there's opportunity here. And that's the bright spot of today.
I agree 100%, especially what you said with multifamily. It's like taking your winnings off the table and, de-risking and trading in. So you're saving taxes there. Don't even get me started on people that are pushing muni bonds. I mean, that's criminal. Well, actually, I'm on a board for our local library, and we sold bonds, and they were at 2.5%. It's like, are you guys insane? This is Illinois. So anyway, Randy, I don't want to take away from the wonderful stuff you're going. So give us a little bit more background then. How did you decide to found Boulder Group, and how long's Boulder Group been around?
So again, I was doing this kind of AT&T thing for a few years. And then in 1997, I thought, well, look, there's enough people here with the problem, not just AT&T owners, others. This is kind of seems like a good niche. There didn't seem to be a major firm in this thing. It wasn't its own sector. So I think, look, I'll try this out for a few years and kind of see how many people, how deep it is, and how deep it really is. So what happened was, you take a few people and one thing leads to another, and it becomes a small little niche. And I wanted to stay kind of a boutique firm because I think that you need to either be a strong boutique or one of the national firms which specializes in everything. I think the danger or less successful place is kind of in the middle, where you're doing a little bit of everything and no one really knows you for anything. So I figured, look, if I can build this little niche and build a little firm, we can be pretty successful despite our small size. So, I mean, look, we're a boutique with less than 10 people, and we're doing 800 million in transaction volume a year, which is, one of the top 10 firms in the country, despite having not a lot of people. So again, if you do the right thing and build repeat clients, and obviously the industry is going our way as far as acceptance and other things over the years, and it's worked out for us. So I think last year is a good example where net lease during difficult times came through pretty well. People sleep better at night in the industry. They like the cash flow. The tenants are high quality, and I think that part of the market, there's always a desire for cash flow. And I think the next few years with an aging demographic, fixed income is even going to be more targeted. And as fixed income is more targeted and people evaluate all their alternatives, I still think that net lease comes out from a safety perspective and from just a yield perspective better than the majority of bond and other alternative options out there today.
Yeah. And I want to add to what you just said with the net lease in particular seems to, the big guys don't really have a great presence there. And they don't seem to have, I mean, I'm not trying to like slam big guys, but they don't seem to have the stuff really, this is a unique niche, I think, in commercial real estate, where the boutiques are probably your most active and probably best coverage and are putting out some high quality information on the net lease sector. And you guys at Boulder are at the forefront of that.
I wanted to highlight that too, real quick, is just kind of get your take on the educational branch of your company, Randy, because I know before this conversation, the main reason why I was aware of who you are in Boulder Group is because of the consistent information that you guys put out there. Is there any secret sauce or anything to the educational branch that you guys have found helpful when creating content? Because I know here at Liberty Real Estate Fund, we're definitely putting together some educational content, and I guess it looks like you've been doing it for a while. So, what's your secret there? Is it just consistency?
Well, look, I wish I could tell you I had forethought 10 years ago that content marketing was going to be a big thing and that, I wanted to get ahead of the curve, but that just isn't true. Basically we started for two reasons. One is we did see this gap of large firms are not in this space. And the most reason they're not in the space is because historically institutions of under $10 million properties are not the major players in them. It's family offices, it's individuals, it's smaller funds and syndicators. So that's a big part of the market. So I think these big firms only ignore it because, look, it's a good market, but it's only a good market if you can do volume. And it's a volume of a lot of little transactions. So it's much easier to go sell a skyscraper in a major metro than it is to do a lot of these deals to get to the same place. So that's kind of why I think it's not ignored, but more difficult for these large firms to do. The reason we kind of started research is twofold. One is we thought, and again, this is 10, 15, 20 years ago, there was a gap to what's available out there. And obviously markets without transparency don't do as well. And, people were asking us for this information. We had nowhere to go. So we're like, look, if they want the information, somebody else is going to need it. So we did it for internal purposes originally because people asked us for it, A. And then B, we also realized, look, we can't go out spend these people on marketing and other things. We're a small boutique firm. So I said, look, we can probably beat them in research. So I thought, we'll spend instead of doing, a bunch of ads or Facebook or whatever it happens to be at the moment, we're going to spend our marketing money on research because it'll get us known and, people will rely on it and people will expect to see it. And so that's what we've become known for because obviously a small firm, everyone doesn't have individual relationships with us like a national presence. So, look, we can carve out a niche in research. So between our clients needing it and between kind of marketing focus on it, research has kind of become our thing and we're happy to have it. We believe in data like everybody else. And, most people who've traditionally been in the brokerage business have been more subjective or gut oriented or just didn't have what they were looking for as far as factual data to back up what they were saying. So it's been good for us and hopefully it's been good for the industry.
When you said you like an $800 million firm, that's per year. How many transactions do you think that is, on average per year?
Last year was 182.
That's not bad.
So it's a lot of small ones. It's a lot of QSR. It's a lot of dollar stores. And luckily, a few of those were portfolios. So we didn't have to do 182 individual transactions, but we definitely did, well over 100.
And I'm going to ask you, what is a QSR? I know what a QSR is, but other people listening might not know what a QSR is.
QSR is quick service restaurant, which is a nicer way of saying fast food, which is probably the more widely accepted term.
And one of the things that I did want to ask you about is during 2020 and into 2021, well, first of all, what were people buying in 2020 and did they shift their patterns in terms of buying what they were buying in 2018, 2019, or did they just load up on more of what they were already buying in 2020? And do you see those same patterns going forward to 2021? So that's a few different questions all wrapped up in one.
All right, I'll take them as they come, I guess. 2020 needs to be bifurcated into a few different quarters. The first quarter was really a continuation of 19, which is one of our best quarters ever. I mean, people forget that just pre-COVID, transactions had been, reaching a fever pitch. It was a very active market. Everyone was kind of optimistic. The stock market was going up. A lot of good things were happening. So it was a great quarter. Unfortunately, at the end of the quarter, COVID came and, caused immediate uncertainty. And so no one kind of knew how to play it or had a playbook for it. So everyone's reaction was just to pause, right? Let's see how this plays out. Let's see how bad it gets. Let's see how much of it comes to the US, vaccines, et cetera, et cetera. So second quarter, everyone was in a wait and see mode. It took the first quarter, which is an amazing quarter, and it kind of took us right back to the averages. It was so poor. As the year went on, people thought, okay, how do I adapt to the current new market, which is I'm going to go for, like every crisis that exists, there's a flight to quality. People go for investment grade. People go for long-term leases. People stay with what they know and what's doing well at the moment, which was essential, things with drive-throughs, drugstores, grocery stores, things you would expect on a flight to quality. I'll pay more, but I'm very happy to own a Chick-fil-A, a Walgreens, a Home Depot. These are all doing well. These are all open. This is where I want to be. So the market bifurcated. People paid an extreme amount of money for the best quality stuff, and lower quality things, like gyms and movie theaters. Not that the cap rates went up, they just didn't trade. People couldn't understand, were people coming back to gyms and movie theaters in numbers, or should I just wait and see? And they're still playing wait and see with those two sectors for what it looks like post-COVID. So in the third and fourth quarter was the same. Fourth quarter volume, was almost back to the year before, but it was only in certain names, right?
Okay.
So it was only in investment grade for the most part. It was only in 10-year plus. It was only in safe, but safe, had a huge demand for safe.
Can I ask you what is investment grade too? Just so somebody listening understands that.
Standard & Poor's and Moody's rate different tenants by their debt and their ability to pay it back over time. Typically the highest investment grade is AAA, then it goes on a scale, AA, single A, triple B, and below triple B, you go back to non-investment grade or more speculative grade is what it comes down to. So obviously, a AAA is the safest. Not many of those around, but there's some single and double A's, grocery stores, major pharmaceutical companies, etc. And so, so the second part of your question, which was what's going into this year. So, the first quarter is pretty much what happened in the last two quarters. It's still the flight to quality. People are still looking for whatever price, McDonald's and Starbucks and everybody who's essential drive-through, fits all the boxes that they're looking for today is going towards. But the consensus now is, look, as the year goes on and as we kind of understand the picture of a new administration as to what their plans are, combined with a rollout of a COVID vaccine, and hopefully most people are pretty optimistic about quarter three and quarter four regarding kind of a post-COVID or COVID fading away to a decent extent during those periods. I think people go back up the risk curve, shorter term leases, second tier tenants. So again, while we're trading a narrow band of tenants, but we're trading them pretty aggressively, I think that expands as the year goes on. And I think by the end of the year, people will be buying, gyms and movie theaters. I think people just are playing, the show me game, which is, I want to go see the new enrollment numbers at Lifetime Fitness or LA Fitness, post-COVID to see how many people are back and how many people have decided not to go back. But once people get the transparency, they can put at least a number on it. Right now, people have to make wild guesses, which they're unwilling to do.
Right. And can you give me an idea? So you mentioned Chick-fil-A, which is probably one of the highest grossing, restaurant chains in the industry. So can you give me an idea? What would be, you said that, a little bit, lower down on the risk spectrum. I'm sorry, higher up on the risk spectrum. What type of tenants would those be?
Non-investment grade that are high on the spectrum, or like Bed Bath & Beyond, Dick's Sporting Goods. It's some of the big box that fell out of favor and some tenants that didn't have great models before COVID, but COVID kind of accelerated things which were already in decline. So if you were going to decline over the next 5 years, maybe you declined in one. And you see, look, there's some second tier restaurant chains that ran into some trouble, from Ruby Tuesday to Applebee's. Some of them were just, concepts, menus that hadn't been updated for a different generation, restaurants that have been, dated and out, different business models that, again, were probably in slow decline anyway, put them into more rapid decline. I think people just don't want to speculate on it. They'd rather see the turnaround first, or a bankruptcy and understand which ones are viable locations, which ones are non-viable before they invest. So that's kind of where the risk spectrum is for other stuff. And I think casual dining had a lot of that too. Look, casual dining, through no fault of its own, had, most of them didn't have drive-throughs, and most of them weren't, they're a sit-down business. Obviously, sit-down businesses have been challenged last year. And I think, people want to see how the numbers look like as they start to come back.
So I want to hit on that a little bit. What you are kind of saying is right now, a safety thing, if you were looking into, long-term prospects, somebody that has a drive-through might be a safer bet right now than, like, let's say I've got Longhorn, and Darden Restaurants, was fantastic to work with and all the rest of it. But, unfortunately, they were closed, and especially in Illinois. And I've got a few other of those fast casual sit-down restaurants. And what I see some of them doing, even Shake Shack is like doing drive-throughs now and stuff. So do you think that moving forward, a drive-through is going to be rewarded with perhaps lower cap rates or lower risk?
Yeah, no question. Look, the drive-through is not only good for the customers, more businesses rely on, services like Uber Eats and DoorDash drive-throughs make it much more convenient for those people to do, effectively takeout business and curbside business. So, I think the pandemic has highlighted the benefits of it. But I think, again, it's not just for the customers who are actually driving through. It's for the DoorDash person who wants to, doing takeout orders for Longhorn. Quicker to get them in and out as well, better for their business.
Sure.
Yeah. Wow. Interesting take. It probably makes it even easier for the employees to a certain regard too, when they have the orders coming through in advance instead of just taking them on the spot. Other thing I'm wondering too, to kind of shift gears here, is what are some of the mistakes you tend to see from like rookie or beginner investors, or maybe individuals who are, making their first appearance into the net lease space? They see maybe some of the benefits that we've been talking about today, and they're really excited and want to do their first deal, but maybe something pops up that they weren't expecting or considering. What are like some of the common mistakes you see?
Well, look, I think that there's similar kind of across asset classes, which is there's a time to chase yield and there's a time to not chase yield. And, the time to chase yield is when there's a large spread between the best and the worst. And then when it compresses to a narrow band, people are still looking for yield, but they're not getting paid for the risk. So let's just use the dollar sector as an example, meaning 15-year dollar generals trade generically at the moment in the 5.75 to 6 cap range. And, they're not differentiated enough between ones that are in growing, maybe tax-free states near a major metro, not necessarily in, because that's not their business model, but, that may trade at a 5.75 and you may get a 6 for, a location in the middle of a 10-mile population of 12,000
Centralia, Illinois, or something like that. And
yes. So look, for the 15 years of the initial lease, you're not going to know the difference. But eventually, the first day you own it, it's a net lease property. The last day you own it, when there's no lease left, it's a piece of real estate. And so for 25 basis points, I want to be near a major metro. I want to understand replacement tenants. I want to be in a market that I can understand kind of where, my reevaluation options are. And, the person in Centralia is, your next thing is a local person, and the local user is maybe paying half of the rent. And it's going to be difficult to sell a local user occupied building, at half
but
the
there
rent.
might not even be any population there at the end of the 15 years either.
It's going to be very
They might all move out.
And my point is, you did it for 15, 20 basis points at the beginning of the 15 years. So while you like the 20 basis points today, you won't really like it towards the end. So again, I think a lot of people get infatuated with grabbing a few extra basis points. Not, it's easy to say net lease is bond-like and it's financial. It is until it isn't. And, on the few non-renewal scenarios, and most are renewal scenarios, so it doesn't happen to most people. But in the events it does happen, you really want a better piece of real estate that, real estate fundamentals still apply of hard corners and traffic counts and growing demographics and non-income tax states and other variables, come into play. So, I think that the rookie mistake is stretching for yield without understanding all the factors that go into that.
Yeah, you know who Ralph Cram is. And Ralph Cram describes a net lease as a bond tied to a rock.
To some extent, yes. But again, I think it's a rookie mistake to go in there and say, look, it's the same 15-year lease as the other one. I can pick up 20 more basis points. The financing's the same. I'm going to go for the cash flow. In the short term, maybe the better move, but longer term, there's dramatically different residual outcomes. And I think that is what rookies don't understand. The difference residually is where, you ultimately have to focus on, because even if they renew, you still only have a 5-year lease, and your future buyer is still looking at his residual and his takeout. So it becomes a bigger factor every day after the day you buy it, because the term is usually shorter when you sell it.
And I'm going to point out some negative things, and I'm not trying to pick on Dollar General, but I've seen syndicators going out and putting together like $1 or $2 Dollar Generals, and they're in the middle of like Podunk, whoever. But the big problem with Dollar Generals that I see is a lot of the newer leases are 15-year flat. So you get no rent increase. So that's another thing that people should take a look at, correct?
No question. I mean, look, everyone makes different inflation assumptions over time, but most people think it's going to, at a minimum, stay the same to go up. Very few people are thinking it's go down, or at least down dramatically from here. At least not people I know. So clearly, a flat lease has its consequences. And again, not that people shouldn't buy high leases. Again, I think it's, are you getting paid for the yield versus the lease, and can you discount it back? That's the thing. And again, podunk to me, there was a time a few years ago when the better versus the worst things traded 100 to 125 basis points. So you were actually getting paid for the podunk, and at least if you had a portfolio of these tertiary markets, you could make the argument that, look, a few are going to lose, but I've been paid for it over time. That's not the case today. So even though it's a market of focused on high quality, A, there's a reason, and B, it's still less risky over time.
Right. And then the other thing that I'm going to complain about, and I've never seen this in a Boulder group offering memorandum, but a lot of brokers will take a Family Dollar store, brand new Family Dollar store, and say that it's a net or NNN. And then when you take a look at the lease, it's the landlord's responsible for the roof and structure. So is that something that you counsel your clients on, to say you're going to have to put some sort of reserve in here for this, or, you want some sort of spread on that?
Yeah, look, I tell them, look, you have to obviously, you have to factor it in. B, obviously, I don't understand why people don't disclose in the OM, because, you're only going to have unhappy people later on. And worst case, you're going to be the subject of a lawsuit for misrepresentation. So it really doesn't do a lot for you to be misrepresented. So I think they should think again. But clearly, look, there needs to be reserved. Again, this is still real estate at the end of the day. And there will be, new roofs or parking lots or other things, which the day will come when you have to pay for these things. Obviously, you need a reserve fund set away.
You guys have from what I've seen, a pretty wide footprint across the country. As far as the opportunities taking place right now, are you able to kind of share with us again some of your secrets? Like, what markets are you most opportunistic about right now?
Again, it's a function of cap rate, which is, look, I'm very optimistic on Florida and Texas, but the reality is, the no tax part and some of the growth, the no tax part's worth 15 basis points to a large extent. The growth, you can make your own decision on what it's worth, but let's call it another 5 to 10 basis points. So maybe these things should trade 20, 25 better than other markets. But the reality is they're trading far better than that. So as much as I love them, I could argue that they're overpriced. Also, California's market that historically has always been, 50 basis points or more premium to,
which I've never understood,
a variety of markets. And to me, I look at, growth prospects, which is, not very good demographically. You see a lot of businesses relocating from California as an exodus. And I don't see the market fundamentals as to why it trades at such a premium. Again, historically it had to do with they were growing, which they no longer are. And it has a concentration of retirees and high net worth individuals that's disproportionate to its market. But that aside, the fundamental real estate fundamentals for growth and for rent growth and for occupancy are not that 50 basis points better than other markets. So, that's a market I'm a little bit skeptical of. Markets I like at this point are, as far as cities, is, I like Charlotte, I like Nashville. I pretty much like North and South Carolina. I like Tennessee. Georgia's a good market. Places with growth that hasn't already been factored into the pricing of the market.
Alabama's a great sleeper market too.
It's pretty good. Again, doesn't have enough population to see a ton of product there. So right. I don't talk about it as frequently, but you look at where the growth of these chains is. Obviously, a lot in the retail side, a lot of these chains, QSR, quick service restaurants, on down, they're expanding in these high growth demographic markets. And a market like mine, which is Chicago, it's a more mature market. It has had negative population growth for 4 years in a row. So it's now trading at a discount to the whole net lease market. Some would argue that it should be even trading at a bigger discount because of its internal problems with taxes and business retention, et cetera.
But I want to just kind of circle back on what you just said, a market like mine in Chicago. You're nationwide though, correct?
We are. I'm just referencing my home market as a market that I happen to be in and probably know the best. But yes, our business is a nationwide business because 68% of people that buy net lease properties buy in a location which is not the state that they're located in.
60%? 68%. So almost 70% of people. What you're saying is this is a relatively easy way to get into because you don't necessarily have to completely know the market, and that 70% of the people are buying outside their home market.
Yeah, look, for commercial real estate, it doesn't get easier than this. It has one tenant. It has a long-term lease. It doesn't get easier than this. You don't have to run a pro forma or an Argus or make a lot of assumptions and re-tenanting assumptions. This is as basic as it gets. So it's so passive. And again, especially if you're doing triple net versus double net, it's very easy to, sit in South Florida in your retirement of a multi-family property that you've, sold and move into one of these and just collect the cash flow, kind of is really the goal. And I think a lot of people understand that, and you don't have to be in the market that you're in. And because the leases are so long, it really takes any edge that any local person could have away from you because you're now predicting, 10 to 15 years in the future for your re-tenanting, most tenants, you buy a apartment building, you roll over every single year. You need to intimately understand what the market is. Here with, not a rollover event for 10 plus years, now you need to be a forecaster, much different analysis, what happens 10 years from now versus what happens next year.
And that's what I want to hit on. And you guys have a lot of this information, but historically, net lease properties have probably been some of the best occupied properties in the investment spectrum out of most of the food groups. So I think they're up around 97.5% occupied at least over the last 10 years. I mean, has that been your experience in what your information is telling you?
Yeah, we actually took historical occupancy for the last 10 years from every public REIT, at least, and it's in the upper 70s. I've seen 97, I've seen 98.5, but it's pretty close to that number. Again, these are anybody who builds a freestanding property, anybody who would develop it for them, and anybody who can command someone to do it for them is higher quality in the first place. So unless it's a backfill location, these are day one, at least very strong tenants that are growing and understand it. So, I think
that's a key insight right there. Nobody's going to build for somebody that they're not going to get paid for it. So,
no, they have to know that they can sell it and that they know that if they held it, that the cash flow is going to come in. So you already
or the bank would finance it.
You already start with a better group in general. And, one of my main thesis and why I'm probably more optimistic than ever about the net lease market is that I think that all these second tier strip malls and all these enclosed malls, some of the better tenants are going to come out and do freestanding locations. I don't see why Apple and Lululemon need to sit in an enclosed mall. I don't see any of these tenants that are in strip centers without drive-throughs like Panera or Dunkin' or Starbucks, because they still have some non-drive-through locations, aren't going to move out and to get a freestanding location. They want the drive-through, they want the branding, and people want the convenience. So I think I think all the retail's woes on the other side of the world are all going to benefit freestanding and net lease. That's where I think the real big opportunity is moving forward.
And you just hit on my investment thesis and actually the evolution of my career. We started out demalling malls, and we've been doing renovation of strip centers and extensive renovations. But I saw in somebody wiser than I pointed out 25 years ago or so, don't buy, a shopping center that has an inline Walgreens or CVS. They're going to move out to the out parcel. It's just the evolution of retail. The evolution of retail is better branding, out in front, more access. There's all kinds of things going for net lease properties that you don't get, especially inside of a mall. Inside of a mall, they don't know you're there unless it's, on a website.
Yeah, again, I think just also, consumer habits have changed over time.
Right.
People used to, and I have some teenage girls, used to spend, the day at the mall or hours at a mall. And now they don't do that anymore. They kind of more, want to go to one or two stores, and they're happy to do one or two freestanding stores. There's not a whole experience based upon the mall anymore. It's just a place to go to get, what they're looking for. They still like the experience and to go with friends, but they don't need to go to the whole mall and see 40 stores. They want to focus on two. So it's easier and more convenient for them to go find freestanding locations of Lululemon as an example, shop there and move on. Obviously you also have to compete with e-commerce, and as convenience is better for you, going to an enclosed mall, is a time commitment. Whereas, stopping someplace on the way home is your drive home anyway. It just happens to be a quick side of the road, and you can argue it's faster than e-commerce because it doesn't involve returns. So
you've heard it here, people. Randy Blankstein has said that women are starting to shop like men.
I'm going to avoid saying that, but habits have changed.
Yeah. I mean, wow. The whole interview has been super valuable. And I just feel like the foresight and I guess you could say the predictions that we're kind of making here, I don't know how you could really argue with it, especially just talking about stores like Lululemon and Apple and a few other ones that you mentioned, Randy, moving to the freestanding model. It's kind of like, why haven't they done that yet? I could definitely see that happening. So time to wind it down here, Michael. I'm sure we could keep going if we wanted to, but one thing that we did at the last interview that was pretty cool, and I'd want to definitely flip this over to you, Randy and Michael, see if you have any thoughts that come up. But Ralph Cram shared with us, a lot of the golden nuggets that he remembers when he was early in his real estate journey. Because, for me, my real estate journey began with Rich Dad, Poor Dad, like many other millennials. But I know you guys have been in the business before that was really, a thing. So what are some, foundational pieces of education that you think have really helped you along your real estate journey? And we'll say with net lease in particular, because I don't think there's a whole lot of information on it out there.
Well, my absolute first job out of college was working as an analyst for a firm called Equity Office Properties, which is one of Sam Zell's REITs. And, it was 1991. Now I'm definitely aging myself. The theme was stay alive till 95. And this is from, a billionaire, legendary real estate investor. And his whole goal was, look, I need to get involved in REITs because the REITs are growing. And I just need to keep my company afloat because things were, not well in 1991. But what he taught me he's known for is being a contrarian, which is whatever the accepted logic is today is probably a lot less likely to occur than you think. And things which you think are outliers are probably a lot more likely to occur over time. So, I don't have a feeling on I 100% think this or I 0% think that. I think everything involves a probability. And, I change my probabilities over time. I think one of the former Treasury secretaries said, most people are more sure of everything than I am of anything. And I think that's kind of how I go about it, which is, take everything with a grain of salt, have a flexible business model and understand that, a lot of things that you think are outliers or things that may or may not come true might. So you need to just prepare for all eventualities. And I think that's kind of the advice that served me well.
Wow. So we've got a Sam Zell prodigy on the line, Michael. I didn't know that.
Either did I.
I didn't know that part of his thing. And I think Sam Zell stole that from the ICSC because I can remember I believe it was 1990, the theme of the ICSC Las Vegas show was stay alive till 95. Maybe Sam invented it and they stole it from him. So I wouldn't
maybe it was consensus at the time. I just didn't know it.
Yeah, no, I wouldn't bet against Sam.
you won't be that wise over time, no.
Yeah.
Awesome. All right. Well, here we are closing things out. Just want to get a few more final remarks out of both of you. I guess we'll start with Michael and then close it out with Randy. So Michael, did you have any other questions for Randy? Any other statements before we get out of here?
No, I just want people to know that they should go to, and Randy's going to give the website, but they should go to Randy's website because there is a plethora of information. So if you are looking to, not only if you are an experienced investor and you want to know market research, you want to know cap rate research, you want to know historical research, they've got it there. But if you're new, they've also got stuff to explain certain things, what's hot in the market and all the rest of it. So I just, really want to thank Randy for coming on and giving us this type of knowledge. As I was telling him earlier, and you mentioned Rich Dad, most of the people that I meet I'm going to a conference next week. And I guarantee you, everybody's got into that because it's a multifamily conference. Everybody got into that by reading Rich Dad Poor Dad. And so everybody says, oh, did you read Rich Dad Poor Dad? I'm like, well, no, I've been in the business before the book came out. There's people like Randy that have an insane amount of experience and information. And so I would recommend looking for those people that might give you a little bit different viewpoint of, hey, there's other businesses out there and what should I look at? So thank you very much, Randy, for coming on. Really appreciate it.
So yes, thank you very much for having me and Nothing But Net. I'm a regular listener, so obviously a big fan of you guys. And B, just to reference, it's bouldergroup.com and you go to our research page and we have 13 net list reports up there. No registering, great way to kind of catch up on what's going on with the industry to get yourself at least an initial education.
So that's bouldergroup.com.
And bouldergroup.com and just hit the research button and you'll see all of our research reports.
Thank you.
Fantastic. All right. Well, ladies and gentlemen, thank you so much for tuning into Nothing But Net, the podcast for triple net commercial real estate investing. I'm your host, Adam Carswell, joined by our co-host, Michael Flight. And today we were joined by Randy Blankstein of the Boulder Group. Thank you so much for investing your most valuable resource with us, your time, and we will catch you in the next episode. Thank you once again for joining us here on Nothing But Net, the podcast for triple net commercial real estate investing. If you enjoyed what you heard today, one last friendly reminder to like, share, subscribe, or leave a review for us. It really helps a ton with the show's visibility. For the Nothing But Net team, I'm Adam Carswell. Take care.
Nothing but net.
The Nothing But Net podcast is not intended to provide legal, tax counsel, or accounting advice. Adam Carswell, Michael Flight, Concordia Realty Corporation, Liberty Real Estate Fund, LLC, and their affiliates do not provide tax, legal, or accounting advice or the worthiness and promotion of any particular investment. This material has been prepared for informational purposes only and is not intended to provide and should not be relied on for tax, legal, or accounting advice. You should consult your own tax, legal, and accounting advisors before engaging in any transaction or undertaking. We highly encourage individuals and investors to seek the counsel of a qualified attorney as well as seek the counsel of a tax professional or certified public accountant to determine if there are any potential tax liabilities or consequences as a result of anything contained herein. All listeners of this podcast or video should understand that there are no guarantees of any success, outcome, or profitability of any transaction or undertaking, expressed or implied, and will not be liable for any financial or other losses or damages incurred as a result of any undertaking. Go to nothingbutnet.us for a complete set of disclosures. Thank you.